So, you're a business owner and you're thinking about selling your company. It's the moment you've likely been working toward for years. For most owners, the focus immediately goes to the deal itself, the valuation, the negotiations, the headline number. And to be fair, that focus makes sense. Getting the right price matters. But in my experience, the costliest mistakes rarely happen in the negotiation. They happen because of what wasn't planned for before the sale ever closed. There's an old saying that wealth isn't just about what you make, it's about what you keep. And when it comes to selling a business, that statement becomes very real very fast. In this video, I want to walk you through our pre-liquidity checklist. These are the key financial planning steps business owners should be thinking about well before a liquidity event, so the sale becomes a transition you're prepared for, not a surprise you're reacting to. The first step is getting a formal valuation, and this is about much more than a number. Most business owners already have a value in their head. That number is usually based on past offers, industry rules of thumb, expected multiples, or what they believe the business should be worth. A formal valuation is different. It forces you to see the business objectively through a buyer's eyes. It stress tests your assumptions and highlights the strengths and weaknesses a buyer is going to focus on. In many cases, it reveals risks you still have time to address, whether that's customer concentration, margin volatility, or operational dependencies. This isn't just a negotiation tool, it becomes a foundation for your entire post-exit financial plan, because everything that follows depends on understanding what a realistic outcome actually looks like. The next step is reviewing your tax and estate structure early, not after the deal is signed. This is where timing matters more than most owners realize. Once a letter of intent is in place, many planning opportunities disappear. You want these conversations happening 1 to 3 years before a sale, not 1 to 3 months. That means sitting down with your CPA and wealth advisor to evaluate how the business is structured and whether you may qualify for strategies like qualified small business stock. It also means revisiting your estate plan with a very different lens. Most estate plans are designed around a certain level of net worth. A liquidity event can change that overnight. A simple will and a living trust structure that worked before a sale may be completely inadequate after an exit. Trust structures, asset protection strategies, estate tax projections, and long-term legacy planning need to reflect the new reality that you're about to step into, not the one you're leaving behind. Now, before I go any further, I want to pause and be clear about something. At Tycrest, we built our entire firm around helping families navigate complex transitions just like this. We service what we call the family wealth gap, the space between wealth management and family office services. These clients typically have investable assets of 10 to 50 million and need someone to coordinate their entire financial life, which includes interacting directly with their CPA, their attorneys, and any other advisors. This type of service model is not available at traditional wealth management firms, and family offices don't service families with less than 50 million. This underserved area is what we call the family wealth gap, and it's where we have honed our craft. We work with families who expect higher levels of service, sophistication, and communication. We intentionally keep our client to advisor ratio low so we can provide the level of attention these clients demand. If that sounds like it might align with what you're looking for, there's a link in the description below where you can learn more about how we work. Now, let's get back to the checklist. Another critical step is creating a clear investment strategy for the day after the sale. Imagine waking up to the largest wire transfer of your life. In that moment, the pressure's intense. Emotions run high. Family, friends, and acquaintances suddenly have a very strong opinion about what you should do next. Without a plan, it's easy to make rushed decisions with life-changing money. That's why we believe the initial post-liquidity investment strategy should actually be written before the sale ever happens. This first phase isn't about chasing aggressive returns. It's about capital preservation, risk management, and creating the income needed to support your next chapter. We often describe this as building an all-season portfolio designed to give you stability and opportunity across a wide variety of market conditions. The final piece is making sure you have a true quarterback. A business sale involves a lot of highly skilled professionals. Your M&A attorneys are focused on driving the deal forward. Your CPAs focus on protecting you on the tax side. Investment bankers, estate planning attorneys, and other specialists all play critical roles, but each of them is operating in their own lane. Quarterback is the one who sees the entire field. Your family wealth advisor should be coordinating these professionals, connecting decisions across disciplines, and making sure everything aligns with your long-term goals, not just the transaction in front of you. That coordination is often what prevents small oversights from turning into very expensive mistakes. Selling your business is one of the most significant financial events of your life. The work you'll do in the years leading up to the sale can have an outsized impact on what your financial future actually looks like afterward. Proper planning is what separates a good exit from a great one. If you're a business owner thinking about an exit and want to understand what a coordinated approach could look like for your family, there's a link in the description to schedule a conversation. We can help you ask the right questions and prepare for what comes next. Thanks for watching, and I'll see you next time.